Right, thank you very much, Lars. We just have one day to go, so see you tomorrow. Thank you for your time. We move on to the U.S., where the stock index futures pointed to a relatively flat open today as traders eyed data, earnings, and any news out of Europe, where the Governing Council of the European Central Bank is meeting. On the data front, initial jobless claims are set to be released at 8:30 a.m. Eastern Time, with import and export prices all set to come out at the same time. In Asia, equities finished in negative territory today after China's inflation data painted a mixed picture. China's producer price index jumped more than expected by 7.8% in February from the previous year, the fastest pace since September 2008. In contrast, consumer prices slowed from a year ago to 0.8%, its lowest pace since January 2015. And the Shanghai Composite closed down 0.74%, and the Shenzhen Composite fell 0.73%. Hong Kong's Hang Seng plunged to 1.18%. Japan's Nikkei 225 finished up 0.34% as the weaker yen spurred buying. All options are on the table, of course. All right, back here, research analysts at financial derivatives company are almost certain that headline inflation is set to decline for the first time in 16 months when the NBS releases the numbers next week. Now, according to them, this forecast is based on a regression model and empirical analysis. Let's discuss more of this with the head of research at Financial Derivatives Company here in Lagos, Damilola Akimbami. Good afternoon, Damilola. Thank you very much for joining us.
Good afternoon, Chimezie.
The February inflation figure is set to be released on March 15, and FDC's position is for a decline to 17.1%. What is the basis of your projection?
Well, our basis is on a simple regression that we used, and inflation is the rate of, it measures the rate of any change in the consumer price index, which is a basket of consumer goods, and it's done on a year-on-year basis. So based on the regression that we carried out, what we noticed or what we're expecting to see is a moderation from 18.7 in January to about 17.1% in February. And that's basically because base year effects are waning. And the base year that we used in our computation is February 2016. And we look at February 2016, the inflation rate actually jumped from 9.6 in January 2016 to 11.4% in February. And that was also because of the exchange rate. We saw the exchange rate of the power market move from about 3.10 to $1 to 3.25. So basically, it's what we're saying is base year effects are winning. We are now using a larger amount for comparison, and so that is trickling into our analysis. And obviously, there's consumer resistance that is still at stake.
Now, commodity prices are yet to ease, and if your forecast is accurate, does that mean we expect to see a decline in prices?
Well, the fact that we are projecting a decline in inflation does not mean that consumer prices have actually declined. And like I mentioned earlier, what we're looking at is the CPI. What we're expecting to see is a decline in the CPI. And right now, if you even look at consumer goods, most consumer goods are still trading around their current levels, apart from rice, flour, and beans that have recorded marginal declines. Consumer goods are still trading at the prices that they were trading at January, February. And that's, again, bear in mind that you're looking, or what we're talking about, the inflation numbers we're talking about are for February. So they're historical numbers. And in February, the exchange rate was 5.20. So manufacturers bought the inventory they're carrying now at that rate of 5.20 to $1. So until we see, or right now the currency is trading at 4.65. So until manufacturers can actually exhaust the current inventory and purchase at the new price or exchange rate of 4.65 before you see any impact trickle down on consumer prices.
Now,
go
ahead, Damilola.
To answer, yes. So also to talk about the outlook, whether we expect to see a decline in consumer prices, that would also, like I mentioned earlier, also be a factor of how soon manufacturers can access dollars at 4.65 that is trading at. I know because of the different intervention of the central bank, we've seen liquidity improve and we've seen the naira appreciate. And most of these interventions have a time frame. there are about a 60-day maturity, which will mean about April, May, before manufacturers have access to the fund. So it's until that time before manufacturers can actually purchase at that rate. So until then, we don't expect to see any drop in consumer prices that will be significant.
Okay, you're predicting a fall on inflation rates. We have seen the oil price, trend downwards. How would you put this, together in the inflation with the oil price we're seeing trending down?
Yes, well, first of all, where oil prices declining, and today that we saw oil prices, at least that for Brent, dropped to about $53, and that's because the market is anticipating an increase in the U.S. Fed interest rate next week, and because of that, so they are dumping. And if the cost of funds increase because of the inverse relationship, we expect to see commodity prices decline. Commodities that are priced in dollars like oil, we expect to see their prices decline because of a stronger dollar. And what that means for Nigeria, because we receive about 90% of our forex from oil proceeds, definitely it could threaten our oil revenues. And since we receive a significant amount of our dollars from oil receipts, we might see the recent accretion in external reserves slow. And the frequent intervention the CBN has been doing in the market might actually, even if the interventions continue, the volume that the CBN is putting out in the market might actually taper off. So for Nigeria, that means that if oil prices decline, it might affect our oil revenues, it might affect our external reserves, and even on the fiscal aspect, it might affect us. But bear in mind again that for revenue or output, I'm looking at price and production. Production right now is anticipated about $2 million per 2 million barrels per day, and oil prices are about 53. So if we can still maintain this increase in production, or at least maintain that level of 2 million barrels per day, depending on the one which carries a larger weight, and for Nigeria is more production sensitive, the impact might not be as significant. And right now, the $53 is just today. Year-to-date average has been $55, which compared to our benchmark there's still some room for revenue.
All right, Damilola, thank you very much for your time. Well, that was Damilola Akimbami, the head of research at Financial Derivatives Company. We'll take a quick break. We'll be right back.